You needed more evidence of why there's been so much interest in gold stocks in 2020. Look no further than the latest results from Agnico-Eagle, the company seeing its cash from operations climb thanks to the price of gold. Just looking at bullion today, it's nearly 25% higher than it was at the same time last year. And with more money coming in, Agnico giving some of that money back to shareholders, they boosted their dividend by 75%. Sean Boyd's the CEO of Agnico-Eagle, and he joins us this morning. Nice to see you.
Great to be here.
Let's before I get into the dividend and some of the investor stuff, I do just want to talk about operating during COVID-19. Sean, last time you were with us, you shared a lot of detail on how you had been navigating operations during the pandemic. And in recent days in this country, it's no secret, we're watching in provinces like Quebec as well, these elevated case counts. How do you feel about operating through a so-called second wave?
That's a great question. And I think part of our ability to manage through a second wave was really getting ahead of this early. And as you said, in the second quarter, when it hit first, we were early on testing. We're currently expanding our testing. We're introducing and getting more labs up and running. So that's been a key part of how we've been able to keep our employees safe and keep their families comfortable. But I think a second wave is really, mining was considered not essential in several of our jurisdictions. As you know, we were down either suspended operations or at minimum activity on 7 of our 8 mines. And we found that as we moved through that second quarter and were able to demonstrate that we could operate safely, we were able to open up earlier than general industry. So I think governments realize the economic benefit of mining, the profitability of mining, and the fact that we can keep our employees safe put us in good stead to manage as we see case counts go up. And a big part of that is testing.
You know, so that's helpful on the operations front, and we'll continue to monitor all that. What I think is so interesting, as you have continued with operations and the gold price being higher has really brought in more cash to the company, and we talked about the dividend boost. This is the norm, it feels like, in the sector. Everybody's watching. They're very aware that the gold price is going up. They're looking to each company for signs that you are going to be doing shareholder-friendly things. Maybe you can shed some light on the thought process behind the dividend hike and what you expect from the industry players as well.
Well, this is a critical time, as you said, and it's really the first quarter that the industry can, let's say, flex its muscles in terms of demonstrating the ability at current production levels to generate significant amounts of cash flow. And it's no surprise that we're seeing, based on the gold prices, these cash flow levels. But the key question we're hearing from investors is, what are the companies going to do with that cash? And for us, we've paid a dividend for 37 consecutive years. In each of the last 6 years, our dividend in terms of total amounts paid has gone up. So dividends have been a priority for us. And so I think it shouldn't be surprising that we're taking the lead in terms of moving the dividend up. That's the responsible thing to do. But our strategy is not just based on our ability and willingness to return capital to shareholders in the form of dividend. Right along with that strategy for several decades has been a consistent investment in the assets in a way that actually adds per share value. So it's the combination of those two. So I think it's important because there are more generalist investors that are starting to take a look at the gold space now, and they're just looking for high quality businesses that happen to be mining gold to give them the leverage to gold. And a good sign of a high quality business is their ability and willingness to pay dividends, in our view.
You know, you're getting into something that I think is really important to talk about. A rising gold price lifts many boats, and there are a lot of investors looking at the sector right now. And I wonder if you worry about some companies that are opportunistic, that might be ultimately bad actors, that investors need to be cautious on the kinds of companies they are investing in when there's so much enthusiasm surrounding this sector.
Well, absolutely. I think that goes for any industry. I think one of the challenges as far as investor perception goes with the gold space is that 12 years ago when gold was running, the industry really failed to deliver the margin expansion that was expected and promised. This time, I think there's a couple things that are different in terms of the investors or the company's ability to meet the investors' expectation. We're not seeing a lot of input price pressures, and the reserves are really done at conservative gold prices. Most companies are using $1,200 to $1,250. So the base at which these mine plans are set for the next several years are solid. So the businesses are well positioned. The missing question or answer is, are the companies going to remain disciplined? So when you look at any business, it's really around management track record and trust, and that should be a primary consideration as investors look at which companies within the gold space they want to put their money with.
And just to build a little bit on the math there, with gold trading in the 1800 range today, you talked about running some businesses in the industry on the expectation of $1,250 as a price. Last time you were with us, you talked about not being surprised of gold making its way towards $2,500 in the next 2 years. Speaking of those next 2 years, you said something else last time which I thought was quite interesting, especially in a week where we're talking about, consolidation in Canada's energy sector. You saw the Cenovus Husky deal, that you feel like the industry in 2 years will not look the same as it does today. So what are going to be some of those key catalysts? Like, if companies aren't returning money to shareholders in the form of dividends, or even if they are, is consolidation a reality?
As we said last time, anytime you tend to see price movement in the underlying commodity, you tend to get industry consolidation. And what everybody knows about the gold space, it's still an industry where there's far too many companies relative to the base metal space or even the oil space. So there really needs to be consolidation. But what investors and owners of these companies are looking for is smart M&A, smart consolidation, not just M&A and consolidation for the sake of saying you're bigger. There has to be a business case to be made, such as synergies, lowering risk, ability to manage bigger projects. So certainly the underlying fundamentals are there for more consolidation, but I think what the industry needs in everything it does, whether it's dividend policy or reinvesting in new projects or M&A, it's got to be done from the perspective of discipline and returns on a per share basis.
Sean, always good to get your insight. Thanks very much for stopping by this morning. That's Sean Boyd, CEO of Agnico-Eagle.